Good day. Thank you for joining me. I'm Warren Davison and I'll be taking you through the March 2020 PSG Wealth Offshore Fund performance. Setting the macro theme, the spread of COVID-19 and the plunge in oil price profoundly affected global markets in the first quarter. Equities suffered steep declines and government bond yields fell as investors favored their perceived safety. Emerging market equities tumbled, slightly underperforming developed markets, as a strong US dollar proved to be an additional headwind. Government bonds saw yields fall as investors sought out assets perceived to be lower risk. Corporate bonds underperformed those of government bonds. What we saw in March: interest rates were cut by majority of the world's central banks in order to relieve some of the pressure felt by COVID-19. In South Africa, we saw a flight to safety with investors pulling capital from riskier EM economies. This risk-off sentiment caused a spike in bond yields in South Africa, whilst a fall in bond yields in the US. As we can see from these bond indices, not all bonds react the same way to interest rate movements. The flight to safety caused a price loss on the broader high-yielding corporate and investment-grade bond indices. Looking at the PSG Wealth global portfolios, the Wealth Offshore Fund-of-Fund range had a mixed month, with the higher equity counters outperforming their benchmark. Over the minimum recommended investment period, the global funds are above their benchmark with the exception of the Global Preserver. Relative rankings remain strong across the board. However, there has been pressure experienced on the lower end of the risk spectrum. Over the recommended holding period, which is illustrated by the circles, here we have achieved top quartile for 3 of the 6 funds. The PSG selected managers had an above average month, with 54% of the underlying managers outperforming their peer group averages over the last month. Value stocks lagged growth for the first quarter, with the MSCI World Value and MSCI World Growth net return returning negative 26.8 and negative 15.1 respectively. Looking at the quantitative and qualitative risk radar, 9 funds appeared on the quantitative risk radar for the month. Templeton Global Balanced appeared on the qualitative radar due to manager changes. Looking at the portfolio drawdowns, the chart here shows the 10 worst drawdowns by the MSCI World net return over the past 6 years. I've also included the current drawdown as a comparison. And what is interesting to notice is that each portfolio has in fact delivered according to its risk mandate, with those portfolios holding higher equity exposure falling more than those with less exposure. As a final point, the current market environment added different challenges which allowed us to stress test our portfolios and underlying managers. Our expectations around each portfolio are: for the Global Preserver, the fund captured slightly more downside than we had expected. Due to the rapid movements in interest rates, those more defensive positions only marginally protected. Higher dividend-paying stocks also sold off more than expected. Global Moderate, the fund captured more downside than we had expected. Manager selection here did not contribute as we had hoped. The Global Flexible Fund performed better than our expectations. The exposure to ESG-focused companies and managers being more conservatively positioned added significant protection. The Global Creator, the fund performed in line with our expectations. Due to the exposure to active managers, we expected the fund to capture less of the downside compared with the MSCI World Growth, and the fund achieved this. Thank you for attending this performance update. Please take note of the following disclaimer, and should you have any questions, please feel free to contact us.